If this breaks, prices won't be the only thing rising. China was sold as the ultimate shortcut to cheap goods and endless supply. One country, one factory floor, zero headaches, or so it seemed. But that promise came with hidden costs that now hit checkout lines and paychecks. From electronics to clothes, delays and price jumps feel personal. And suddenly, the system everyone trusted looks fragile. The old story says China's model is unbeatable, just temporarily stressed. But reality looks more like stress fractures spreading through concrete. Labor is pricier, politics are louder, and risks stack faster than profits. Global supply chains weren't built for this much tension, and when pressure builds, something always shifts. By the end of this video, you'll understand why Vietnam Next China isn't a slogan. It's a response to fear, risk, and survival in global markets. You'll see how Vietnam manufacturing fits into this new world, and why this shift matters to inflation, jobs, and stability everywhere. Stay until the end, because the final question might flip how you see globalization. For years, China looked like the safest bet in the global economy. Cheap labor, massive scale, lightning-fast production, what could beat that? But here's the uncomfortable question. What if that machine starts stalling? What if the world's factory suddenly isn't so reliable anymore? And why would that matter to your wallet right now? China's costs aren't creeping up, they're jumping, especially in wages and energy. An aging population means fewer workers and higher pressure on salaries. Add trade tensions, sanctions risk, and political uncertainty into the mix. That uncertainty flows straight into global supply chains and consumer prices. When factories hesitate, shelves thin out, and inflation sneaks into daily life. Think of it like relying on one massive paycheck for your entire household. It works great until overtime disappears or the company changes the rules. Global CEOs are asking the same question families do. What's the backup plan? This is why Vietnam Next China isn't hype, but risk management logic. Because when one factory dominates everything, a single crack can spread fast. Companies didn't wake up one day and decide China was over. They woke up panicked when shipments stopped, ports closed, and timelines collapsed. That's when a quiet phrase started dominating boardrooms: China plus one. Not a trend, not a protest, more like an insurance policy. Why bet everything on one factory when the world feels this unstable? COVID didn't just delay products, it exposed how fragile global supply chains really were. Tariffs turned predictable costs into political bargaining chips overnight. A single lockdown in Asia manufacturing hubs rippled into empty shelves worldwide. Prices jumped, delivery dates slipped, and businesses missed entire seasons. Consumers felt it fast: higher prices, fewer choices, longer waits. Think of China plus one like diversifying investments instead of going all in. Companies aren't quitting China, they're hedging against disruption. That hedge is flowing into emerging markets Asia at record speed. Vietnam factories keep showing up because they're close, affordable, and ready. But when everyone rushes for the same lifeboat, capacity becomes the next risk. Vietnam didn't force its way into the spotlight. It quietly earned it. Right next to China, but not China, it sits in a rare sweet spot. Close enough to plug into existing supply chains, far enough to reduce risk. That geography alone makes investors pause and lean in. So why does this location matter to prices and jobs right now? Vietnam's government has spent years courting manufacturers, not fighting them. Political stability, tax incentives, and trade agreements lowered entry barriers fast. A young workforce keeps wages competitive while education levels steadily rise. Ports, highways, and industrial zones expanded to handle real volume. This setup feeds Vietnam manufacturing growth while keeping costs in check. Think of Vietnam like a starter city that suddenly sits on a major highway. Traffic was inevitable once the route became unreliable elsewhere. Investors track Vietnam economy metrics because momentum compounds quickly.
Vietnam versus China comparisons now show efficiency beating sheer size. But fast growth always tests systems, and strain shows up before headlines do. This isn't a future plan, it's already happening on factory floors. Production lines are moving, not in theory, but in trucks and shipping containers. Electronics, shoes, furniture, everyday items are changing zip codes. If your last purchase arrived faster or cheaper, this might be why. So where is this shift showing up first? Vietnam factories are expanding in electronics, textiles, and key components. Global brands aren't testing pilots, they're relocating real production capacity. Ports are widening, industrial parks are filling, logistics are tightening. That efficiency plugs directly into global supply chains with fewer delays. The result shows up at checkout: steadier prices and fewer stockouts. Think of this like rewiring a house while the lights stay on. Risky, expensive, but cheaper than a blackout. Vietnam manufacturing works because it integrates, not isolates, from Asia manufacturing. That's why Vietnam growth feels quiet but relentless. But scaling fast brings bottlenecks, and those pressures don't stay invisible forever.
Here's where the optimism hits resistance. Vietnam looks fast, flexible, and affordable, but can it really scale like China? China built an ecosystem, not just factories, over decades of repetition. Suppliers, ports, capital, talent, everything stacked in one place. So when people say Vietnam versus China, are they comparing reality or expectations? China still dominates in speed, volume, and vertical integration. One city can handle what an entire region elsewhere struggles to manage. Vietnam faces limits: land, infrastructure strain, rising wages, tighter labor pools. As demand surges, costs follow, and that pressure shows up in prices. For businesses, scaling mistakes mean delays, penalties, and lost market share. Think of Vietnam like a high-growth startup, not a tech giant yet. It doesn't need to replace China to succeed. It needs to complement it. That's why Vietnam next China is the wrong framing for smart companies. The real win is diversification across emerging markets Asia. But if Vietnam absorbs too much too fast, the same cracks could reappear. Calling Vietnam the next China sounds simple, but it misses the point. China rose in a world that no longer exists. Cheap energy, open trade, low tension. Vietnam is growing inside a fragmented, cautious global economy. Different rules, different risks, different opportunities. So what happens when history doesn't repeat, but mutates? Vietnam growth isn't about one megafactory feeding the entire planet. It's about fitting into a multi-hub Asia manufacturing network. Production spreads across borders to reduce shocks and political risk. That diversification stabilizes global supply chains and softens inflation swings. For workers and consumers, that means fewer sudden price spikes. Think of globalization less like a pyramid and more like a web. No single center, but many strong nodes sharing the load. Vietnam's economy benefits by staying flexible instead of dominant. Other emerging markets Asia are watching and copying the playbook. But a fragmented system trades efficiency for security, and that cost adds up. This isn't a story about the past, it's unfolding in real time. Understanding Vietnam next China helps explain why prices feel unstable lately. It shows why some jobs move, others appear, and supply shocks hit faster. For careers, investments, or even reading the news, this context matters. Because global shifts don't announce themselves, they show up on receipts. None of this is locked in stone or predetermined. Countries adapt, companies adjust, and people who understand trends move earlier. Following Vietnam economy data or Asia manufacturing shifts sharpens perspective. Reading sources on global supply chains builds long-term clarity. Awareness turns uncertainty into optionality, not panic. Do you think Vietnam growth can stay stable under this pressure? Is diversification making the world safer or just more expensive? Which emerging markets Asia do you think benefit next from this shift? Drop your thoughts in the comments and let's compare perspectives.
Subscribe, turn on notifications, and keep learning how geopolitics and economics shape everyday life.